What is going on, guys? We're going to go through the March 2023 charts and chart pack updates from both the RBA and CoreLogic, just trying to understand the property market and what's going on right now. These are the first time going through the charts as usual, so hopefully I get the same reaction as you guys, but good to just understand where the market's at. I'm going to try and roll through it a little bit quicker today than usual, because usually I waffle on for 40 minutes or so, but we'll see how we go. Residential industry is still a $9.3 trillion industry. No sort of majors here since last check-in. Outstanding mortgage debt is about the 2.2 trillion. So nationally, we're sort of around that 20% of LVR nationally wide. Australian dwelling values, so nationally they fell 2.3 over the last 3 months. Down about 8% over the last 12 months, and then the monthly pace of decline has eased sustainably in February. Despite a large annual decline in home values, the monthly pace of decline slowed quickly over February to just negative 0.1. So there is generally a seasonality increase in February, just because both agents and vendors and clients who have missed out or didn't sell over the last 2 months, which is a holiday season, are sort of raring to go back into work, back into wanting to buy, lots of properties starting to come on the market. So generally do see an uptick in that February season, just to allow more properties to come on the market, and people who missed out last year now all of a sudden, fighting hard to get back in, and vendors who might want a bit of a change or weren't able to sell last year to some unforeseen circumstance now have been able to get their properties on the market. So a little bit of a kick up generally in February. 3 months changes. We can see over Australia, as stated before, is about negative 2.3. Combined ranges is about negative 2.1, and combined capitals is about negative 2.3 overall. Worst performer is Hobart at negative 4.9, while the best performer is Perth, which is negative 0.2. And then regional Northern Territory, Western Australia and South Australia are still in positive territory. The good news is if we look at the rolling quarterly change in dwelling values, we can see that both the combined capitals and rest of state are starting to come back up. They are still in negative territory, so the values are still declining, but the rate of decline has definitely started to stabilize, which is really, really interesting to see. 12-month change, though, if we look at this on a bigger picture, a wider view, overall we're negative about 7.9, and regionals is down 4.2, while capitals is down 9.1. Adelaide, Darwin and Perth are still in positive territory. Leading the decline is Sydney at 13.4%, followed by Hobart at 11.8%. And then when we put the rolling change on an annual figure rather than a quarterly figure, we can see that we are still going down in decline for both the combined capitals and the combined rest of state, but we are seeing a little taper off with the combined capitals here, which is great to see. I'm starting to see that slower rate of decline starting to come into play on the annual level with things. Massive decline, as we can see, and when we compare that, we're only going back to 2013, but as generally we can see when we start to go back in time, if we take this 2019 perspective, by any chance, it has been positive most of the time, but it does come down, but it does come up as well. So although the headlines at the moment are super negative and devastating and end of the world type scenarios, these are periods that we do go through. We go through good seasons and bad seasons and seasonality. We're in a down season, but it does change and come back up over time. So capitals, Sydney, Melbourne, Brisbane, Perth are all down. Worst is Brisbane at negative 3.2. And then rolling quarterly change for Perth, Hobart, Darwin and ACT. Everyone is negative. The worst is Hobart at negative 4.9, where the rest of the country is sort of around that 1%, 1 to 2% change. Capital cities, so quarterly change in stratified hedonic dwelling index, 3 months to February. We can see that most of the major declines are coming from the larger 75th percent quartile. So that's the top end of the market falling further. Brisbane, top end of the market is fallen 4.2%. This is on a 3 months to February. Hobart is down 6.1 over 3 months, which is quite large, and ACT is down negative 3.2. Housing cycle. So the rolling 28-day growth rate of CoreLogic Home Value Index, we're back up to the 0 point now, which is really cool to see. We can see this down lull period back in March 22 to September 20. March 2020 back to September 2020. Good peak up during the COVID pandemic there. We reached at a maximum of about 3% on the 28-day change, which is crazy. We have been negative since essentially before September in 2022, maybe August, something like that, maybe even before then, and up until now. So it's been a good sort of 8 to 9 months of being in that negative decline over a 28-day period. However, we are seeing that pop up, and we're now, looks like we're nearly positive. So the rolling 28-day change combined capital value index was 0.0 in the 28 days ending March 7. The decline in home value index slowed steadily through February, though it was uncertain whether the trend will last amid further rate rises in 2023. So either starting to see a really strong recovery, or starting to see that seasonality come into play and having an impact. But yeah, it will be interesting to see with the further rate rises how that will play out for the rest of the year. Sydney's up 0.3% over the last month. Quarter's still down 2.4%, but we can see the rate of decline is starting to ease. And then over the past year, it's still down 13.4% over that year. Melbourne is down 0.4% for the month. Decreased at 2.7% for the quarter, and then down 9.6% for the year. Again, we can start to see that rate of decline slowly averaging out as well. Brizzy down 0.4, 3.2 for the quarter, and then 6.8 for the year. Again, starting to see those rate of decline decreasing as well. Adelaide fairly even at negative 0.2. Negative 1.4 for the quarter, and then still positive for the year at 5.1, which is great to see. Still great to see that they're going through this period and still being positive. Perth about the same. It's kind of averaging out at negative 0.1 or negative 0.2 for the quarter, but still positive overall for the year at 2.4%. Hobart is down 1.4% in Feb. The quarter, it's nearly down 5%, and then over the past year, it's down 11.8%. Still seeing, the same sort of rate of decline in Hobart, no sort of averaging out or coming back to a mean reversion there. So, but it has been impacted the hardest, so it'll be interesting to see how long this lasts. Darwin is negative 0.3 on the month, negative 1% on the quarter, and then still positive 2.9% over the year. Canberra is down 0.5, down 2.7 over the quarter, and then down 6.7 over the year as well. So, but we are seeing a start of a trend there in terms of the recovery of the down period, which is great to see. Sales and listings. So sales volumes continue to trend lower as buyer demand slows. CoreLogic estimates that in the 12 months to February, there were 486,620 sales nationally, which is down 21.2% compared to the previous year. It's crazy, 20% difference compared to where we were last year. Monthly sales volumes averaged about 37,000 over the past 6 months, down from an average of 40,000 over the past 5 years. So about 3,000 less properties selling. When we look at the combined capitals here, Sydney is down 30%, which should really be underpinning the market, and that's probably an element to what we're seeing now with, that positive month in February. What's really underpinning the market and why it's not falling off the face of the cliff with all of these interest rate movements is people don't want to sell. They don't want to sell in a down market, and there's a lack of supply on the market, and that means that for the properties that are on the market, there's still demand, and so they're generally holding their prices or continuing to at least it's in a competitive environment. So it's definitely this lack of supply that's really underpinning the market. So we're still below the 5-year average. The monthly sales volumes did tick up in February, as we can see that seasonality come through, but we see that in every year prior. But if we compare that, as to what we saw last year, it is significantly lower to where we are. And if we look at the 6-month average, again, we are way below the 5-year average line there, which is interesting to see. Median days on market. So at a national level, properties are taking longer to sell. In the 3 months to February, the median days on market was 41, up from a low of 20 days in the 3 months to November 2021. So median days on market is starting to come up, which means that they're generally taking longer than an auction campaign, which is typically 4 to 5 weeks, or sorry, maybe 3 to 5 weeks, depending on how fast they want to sell the asset. But now we're starting to see properties pass in and maybe sell a week after, or maybe they're not going to auction altogether. They're just sort of sitting on the market on a private sale understanding, and it might take a little bit longer to sell. So combined capital is around 37 days, with regionals at 48 days, nearly 2 months for regionals. And if we just look at Sydney, it's gone from 28 days last year to 45 days this year. So it's a big difference where properties are sitting on the market. Same with Melbourne. We've gone from 28 days to 37 days. Brisbane's gone from 13 days to 35 days. It's nearly 3 times the amount of time that the property's sitting on the market, which does have a massive impact. It means there's less people that are interested, and again, really starting to show why we have seen those declines. Vendor discounting. So vendor discounting has also expanded through 2022. However, the 3 months to February, the national median vendor discounting rate contracted slightly to the 3 months to January. So we can see that vendors are starting to, combined regionals are starting to average out. They're still discounting at that sort of 4.5 level, which is, kind of the bottom of where the discounting has been. In the really strong market that we're seeing through the COVID pandemic, the worst it got was sort of negative 2.8, and now we're at sort of negative 4.5. What we're starting to see though is a bit of a tick up in the combined capitals over the last couple of months. We've gone from that sort of negative 4.3 level back up to negative 4.1, which means there's less discounting occurring, which does sort of correlate with pricing. It just means that vendors aren't willing to discount as much. Listings. In the 4 weeks to the 5th of March 2023, the volume of new listings totaled 38,000 nationally. While new listings have seen a seasonal lift, new listings are still negative 12.7% lower than the previous 5 years. Yep, so comparing, the stock compared to last month doesn't have a massive correlation together, just because we can go through seasons and holiday periods and different economic seasons and everything else like that. But when we compare that to at least last year, or that 5-year average, which they've done a really good job. Usually there's like 6 lines on this graph and it's hard to compare together, but what they've done now is we're comparing it just to last year and then the previous year 5 average. So if we're still off 12% compared to the previous 5 years, it's really showing you the lack of stock on the market compared to what we'd usually see. At a national level, there are 144,000 listings observed over the 4 weeks to the 5th of March 2023. Total listings are still markedly lower than the previous 5-year average. I feel like Tim from CoreLogic when I speak, like it's the same way that he speaks. It's actually really funny. But yeah, they do a cracking job over there. So combined to the same time last year, we're down 2.5% compared to the 5-year average. We're down 26.1%. So that's pretty interesting to see. Last year and this year together are still quite low compared to where we usually do sit. I mean, we've gone through some really interesting times. So, I mean, that sort of speaks for itself. But it's interesting to see that during quite a bullish market, we can sort of be at the same level in terms of listings. And in both a strong and a declining market. Very interesting to see where we can compare that to new listings, to total listings. Big change in new listings coming through, but quite comparative to total listings compared to a booming market that we were seeing 12 months ago. New listings advertised were down relative to the same period of last year across most regions, while the balance of total listing stocks is more fixed. In Hobart, Canberra, and some regional markets, total listings are now lifting relative to the same period in February 2023. So again, just sort of showing those new listings being advertised coming on. I mean, overall in Australia, we're down negative 15.4% for new listings changed compared to last year. And then total listings were only sort of down 2.5%, stronger on the regional front, so showing more listings on the regional front. And then capitals is down 5.8%, so really showing a lower lack of total listings in the combined capitals, and for new listings as well. Weekly clearance rate. So the combined capital cities clearance rate averaged 65.8% in the 4 weeks to the ending of 5th of March 2023. While this was a much stronger result than in the final weeks of 2022, averaging 55.1%, auction volumes are still low relative to where they were the same time last year. So clearance rate wise, we're at 65.8%, which is an intermediate market. Anything above 70% would be considered a seller's market, and anything below 60% would be considered a buyer's market. So between 60 and 70%, everything is quite neutral, which is really interesting to see, just given the current circumstances that we're in. But when we do look at volumes, which is on the bottom and looking at the right-hand axis, we can see a significant less number of auctions occurring compared to last year, but probably relative to what we were seeing in 2021 and 2022 in those earlier seasons of the pandemic. But comparing it to last year, it looks like it's a lot less lower in terms of the number. Rental market is in pretty dire straits at the moment. So the annual growth in rent values held steadily in the previous month in February at 10.1%. Annual growth in Australian rent values was 10.2% in the 12 months to December, a record high. The most rapid annual rise is evident in unit rents across Sydney, Melbourne, Brisbane, and where rents have increased around 14 to 17% annually. That's crazy in the units. It'd be great if they broke it down between houses and units. It'd be interesting to see. But combined capitals is up at 11.1% and regionals is up at 7.5%. And that's really interesting to see, because we can see between February 18 and February 21, rents were only increasing at sort of 1 to 2%, where, throughout the last sort of 2 years, it's been increasing at sort of 10%, which is just phenomenal. It's a huge rate in decline. I think, we are coming back to that mean reversion number, which is great to see, but yeah, pretty significant to see that big of a movement in such a short amount of time. So yields, gross rent yields were fairly steady over the month at 3.9%. However, yields have risen from 3.2% in the same month last year. Gross rent yields in February were highest in resource-based markets of National Northern Territory and regional WA. So we can see yields across Australia are about 3.9%. Regionals is at about 4.6%, and then combined capitals as that 3.7%. Sydney and Melbourne are closer to that 3.2 to 3.4 level, with Brisbane and Adelaide around the 4, and then we've got Perth, Hobart, Darwin, and Canberra at that stronger number above the 4s. Darwin's at 6.3%, and then regional Northern Territory takes the winner at 7%. But don't invest for yield. Don't invest just based on the yield, not what I meant to say. Dwelling approvals and housing credit. So in January, monthly dwelling approvals fell 27.6% in the month to the lowest level since July 2012. The decline was driven by a sharp drop across the house and unit segment, with both segments seeing approval trends below the decade average. So we can see that the decade average along here for houses, we are significantly below that decade average now, and same for units as well. It's pretty significant in terms of where we are. I mean, we have been there. We have been at this level a fair few times over the last, call it 4 years, probably even less, maybe 2 years. But for our houses, I mean, we haven't been this low for, they probably set it up here. Since July 2012, 10 years we haven't been this low before in terms of housings, which is really important because, number one, it feeds into that stock number. There's not a lot of stock coming onto the market. And then for the rental market as well, there's not a lot of places to rent coming onto the market, which is pretty crazy. Finance and lending. So new housing finance secured totaled $22.1 billion in January, down 5.3% from December. The combined value of new finance secured in the month fell by around $1.2 billion, declining in levels not seen since August 2020, which is sort of prime time for COVID pandemic. So pretty drastic number. Monthly value of new finance commitments. We've seen a massive decline in both owner-occupier and investors. Significant drop off from some of those peaks that we were seeing beforehand. But portion of new lending for investment housing, excluding refinance. Funny thing is, we are still quite close to that long-term average as well. So long-term average is 34.6%, where it's still at 33.5%. So even though the total finance commitments have dropped off significantly, both from an owner-occupier and investor perspective, when we look at it proportionately, when we're comparing both owner-occupier and investing together, regardless of where the total level is, it's still an average of 33% being for investment purposes. Nationally, investor finance comprised 33.5% of new mortgage lending through the month of January. This is below the decade average of 34.6%, with the total share of secured finance for investment property declining due to a negative 6% fall in investor borrowing over the month. So investors as a portion of total lending across the different states, highest is New South Wales at 39%, and the lowest is in Tas at 24%. But all ranging between sort of 25 to 40%. And then investors as a percentage of housing finance commitment by state, ACT is at 38%, and then New South Wales is at 39%, which is what we're seeing before. They're essentially the same numbers. But Australian on average is around that 33.4%, 5%. First home buyers. So the value of first home buyers finance fell negative 4.9% through January, with first home buyer finance accounted for 22.8% of owner-occupier finance in the month, which is below the decade average of 23.7% compared with April 2022. Monthly first home buyer finance has declined 28.5% through to January. So first home buyer as a percentage of owner-occupier housing by state. Again, very messy graph with all the ups and downs. But what's interesting to see here is we can start to see all the states kind of correlate together and bunch together and get closer together, where in previous years they were in quite disparity. Like, Victoria compared to New South Wales was so different. And even though they're still the bottom and the top, they are much closer to where they have been historically. So first home buyer as a percentage of owner-occupier finance, Northern Territory takes the cake at 30%. And New South Wales is the lowest at 20.2%. The RBA lifted the cash rate to 3.6% in March. Statement highlights, so headline inflation is moderating, and the monthly CPI indicator suggests that inflation has peaked in Australia, which would be awesome. The central forecast is for inflation to decline this year and next, with around 3% in mid-2025. The board acknowledged that the lagging cumulative interest rate rises reaching mortgage repayments, and that uncertainty remains around the timing and extent of slowdown in housing. And then the board changed the wording on the forward guidance from the previous statement from further increases in interest rates will be needed in the months ahead to further tightening of monetary policy will be needed. So hinting that it is a slightly less hawkish path toward monetary policy in the coming months, which is great to see. I mean, obviously we've had 8 or 9 months worth of interest rate increases. We're now at the highest level that we've ever seen, essentially for the last 10 years or longer, 10 to 11 years. So we are very high. We've had probably one of the most dramatic increases that we've seen in history. I actually think it is. I think I've seen all the increases together over time, and this is one of the most drastic and largest changes in the shortest period of time. So hopefully there are some pull downs from this, and it doesn't stay this crazily high, but it'll all be dependent on number 1, inflation, number 2, employment, and then number 3, essentially the rest of the country, or the rest of the world, and the housing market. So housing credit through January, average new variable rates shifted slightly lower for both owner-occupier and investors. Through this trend is unlikely to continue following further rate rises in February and March. So variable rate is around that 5.95% with that new, that's the fixed year, 3 years. And then the variable rate for owner-occupiers is closer to 4.96. For investors, for the 3-year fix, we're at about 6.25, and the variable rate is at 5.28. Housing credits, so mortgage originations from riskier types of lending traded notably lower through the September quarter of 2022. The portion of loans originated with a debt-to-income ratio of 6 or more fell 17.1%, down from the 23.3% in September 2021. And loan-to-income ratios of 6 or more dropped down 7% in the quarter. That's crazy. So percentage of loans on interest-only terms is around 19%, and it's starting to trend down. Lowest we've seen it is about 17.5% back in 2019. Percentage of loans originated with a loan-to-income ratio above 6%, seen a massive drop down to 7.3%. For the last sort of year there, we've been around that 10% level. So really starting to see people be less risky. Percentage of loans originated with a debt-to-income ratio greater than 6 times income. That's down to 17.1%. Loan to income, debt to income ratio, yeah, right. So again, we're sort of sitting around that 24, 23 mark for the last sort of year there, and now we're sort of dropping down to where we were seeing beforehand in the 19-20 period. Back to around that 17% level, which is good to see. I think it's, people are taking less risks based on those interest rates. And then percentages of loans originated with an LVR greater than 90%, we're down around that 8% level for owner occupiers, and down to 2.3% for investors, which is a really interesting number because, I feel like a lot of people talk about, being able to refinance and getting a 90% LVR and using a smaller deposit as we can and leveraging as much as possible. But for the investor side of things, it's only 2.3% of the market, which is very low. The supply tide is turning in Hobart. While most regions have relatively low levels of listing on the market, Greater Hobart is finally seeing a sustained increase in listings. This comes off the back of a long, large housing boom across the city to the mid to late 2010s. Total listings are 73.4% higher than a year ago, but are still negative 16% below the decade average. So definitely seen a big tick up in Hobart over the last couple of years. There's actually been sort of 2 massive bull markets within Hobart, and this supply issue has definitely had a big impact on that. Supply and demand makes it quite simple. And obviously this is sort of flowing into the reason why we're sort of seeing Hobart being one of the worser performers over this period here, is because those numbers are starting to come back to normal. The listings on the market are coming back to where they should be, and that supply and demand ratio is starting to come back to equilibrium, which means there's not as many underpinning drivers of lack of supply with the high demand, which is pushing up prices. So that's great to see. It's always good to see an equal market. Never good to see a market go down significantly. Let's go back to where we were with Hobart. What were we seeing with them? So over their year, they're at 11.8%. So nothing, terrible compared to, Sydney and Melbourne. It's quite on mark. But good to see, a market sort of in equilibrium and come back and go through its cycles. And then we've just got guides and disclaimers. Awesome. Well, that's a great little one. I think that Hobart last little chart was a good overview for chart of the month. Really great to see Hobart come back into equilibrium. So I'll jump into the RBA chart pack for this year. Inflation across the country, across the world. Sorry. So Japan is at sort of that 4-5% level. States is at sort of 6 to 7%, and then euros at sort of that 9% level. So inflation high across the world. GDP growth in Australia is still positive, but is coming down off the back of that sort of boom period that we did see. Biggest contributor is still consumption. Hoping to see consumption starting to slow down a little bit, because that does impact inflation quite dramatically. So yeah, hoping to see a bit of a slowdown in consumption towards GDP. But inflation in Australia supposedly peaked compared to, well, based on what the RBA is sort of saying, but it is very high, that sort of 7.9 level, which is crazy. Measures of underlying inflation. Yeah, it's just looking at it in a different way. Tradable, non-tradable, housing income and consumption. Starting to see that saving ratio come down, which is really good. It was so high for so long, and we sort of banked up all of this cash during the COVID period where really we couldn't spend it. And that's really pushed into inflation because we had all of these savings built up. We couldn't spend it, and all of a sudden, we could go out and spend it all. And so it's really sort of pushed inflation to where it is today. Consumer sentiment is really, really low. We can see here COVID pandemic. This would have been the GFC. It's the lowest it's ever been, which is quite crazy to see. I mean, we've seen two little tick ups on the way back up, but really consumer sentiment is quite low, sort of feeding into everything. So where the market is now, if people don't feel confident about the market, it's going to have a significant impact. Housing prices are ticking down, and then housing debt is sort of averaging out, which is great to see. Household wealth, predominantly the biggest portion of that is within dwellings, followed by financial assets, followed by liabilities. Housing prices we just went through, loan commitments we just went through, and then we've got the business and investment sector here. NAB business survey, so business conditions are looking pretty good. Confidence is at the average, and then capacity utilization is still quite high, which is really great to see. At least businesses aren't hemorrhaging as badly as the market is, but we'll still see the flow-on effects of a couple of banks over in the US starting to collapse now, and you're really starting to see a daunting impact of massive interest rate increases in such a short amount of time. Business lending is still quite high, which will be interesting to watch as those interest rates do start to have an impact on the market. But good to see some of the best businesses are built in down periods, so that'll be interesting to watch. Credit and broad money growth is starting to head down, which is good. Owner-occupier housing, investor housing, and business credit growth is all ticking down. Monetary aggregates, wage price index. So we're starting to see wages go up, which is good and bad. I think wages do need to increase to counter inflation at the moment. It's good to see that it's at the highest that it's ever been, sort of in a 10-year period. At sort of 3.4%, 3.3, 3.4%. The only bad thing about a high inflation increase at the moment, wage increase at the moment, is it does feed into inflation. So the more people get paid, the more they're going to go out and spend. The more they go out and spend, the more prices go up. The more prices go up, the more wages need to increase to pay for those things. And so you have this sort of spiral if wage increases get too high and sort of flow into inflation. They can really, really create this spiral upwards, which is not what we want to see. So you probably do want to see wages, at least average out here or start to come down, so that we can sort of really put a tap on the inflation, the water of inflation coming in. You can really put a hold on that, but it's not sort of detrimental at that sort of level. Employment participation rates. So unemployment rate is the lowest we've seen for, since the 80s, which is crazy. Even the 70s, which is such a low number relative to where we are going to be. This number should tick up, and I've done a couple of posts on it, but seen a lot of unemployment and retrenchments and all that starting to happen at a bigger level. So I don't know how lagged this data is, but it'll be interesting to watch over the next 6 to 12 months. But the RBA are generally looking at this and watching this for those decisions on interest rate increases. For a stronger economy, you want as many people as employed as possible. But obviously more employment and more money going back into people's pockets impacts inflation as well. So we want to keep this employment number at a decent level. Share upon monitor, employment growth by industry. Household services is really increasing, which is very interesting. I'd love to know what exactly goes underneath that, but it'd be things like home cleaning or specific things around the house. So that's really interesting to see. Construction is positive. It's is coming up, which again is interesting because the whole construction industry is slowed down, and business services are starting to come up as well, which is great. Government, so balance sheet is pretty steady from last couple of months that we've seen, and then forecasting ahead, they're trying to be at that -2% level. Got the state coffers there as well. Business commodities, export volumes, credit growth, external positions, RBA assets. Domestic bonds is still the major impactor to RBA assets, which is crazy when you compare it back to like 18 and 19, how small of a percentage it would have been then. Now it's the largest cohort, so really sort of seeing those bonds on the RBA assets, and then same thing with the liabilities as well. They've got to settle those bonds, so it does become quite a large liability as well. Central bank total assets, good to see where with Sweden and New Zealand and everything else, Canada is quite low, but it's good to see at that level. Central banks, cash rate, we've been through policy interest rates, monetary policy in China. Yeah, all of the stuff is looking pretty good. Average housing interest rate, we've been through. Share market and bond market. What's happening in the bond market actually? Bonds on issue in Australia. Government bonds are still the highest compared to non-government or state governments. Bond insurance, exchange rates, Australian dollars. Looking alright. Anyway, I'm just rambling on now. I think we've been through sort of most of the property stuff. Looks like there's a fair bit more in these chart packs than there are usually. Australian bank profitability. So we can see that the majors are profiting at what, 11, 12%? Which is lower compared to usual, but major banks net interest margin just below 2% there. Australian bank profits starting to taper out, but is still quite high compared to what we've seen historically. Crazy. Awesome. Well, thanks for sitting with me going through that stuff. I've still hit 36 minutes, so got it under 40, which is really, really good. But starting to see the economy and all the effects of things starting to take place, really watching inflation number and unemployment for the next sort of 6 months to sort of see what happens with the cash rate. Once things happen with the cash rate, or the wording or terminology around the cash rate starts to change and shift, hopefully that has an impact on consumer confidence or consumer sentiment, and it starts to tick back up. And then with the tick back up with consumer sentiment and maybe either neutral calls on the cash rate changes, or potentially even negative, we can have some more confidence back into the Australian property market and start to see things change from there. But all looking pretty good. I think it's kind of still a wait and hold and see what happens before we make any sort of major decisions. But interesting to see where the economy's at. Thanks for staying with me, guys, and I'll chat to you next month.